Hello, everybody. Welcome to another episode of Brick by Brick by Parvis. Today, I've got Alex from Perch Capital joining us. Perch is a business that I met quite a few months ago. I met Jeremy at a conference here in Toronto, and it's awesome to have worked with them over the past few months and bringing their investment offer to Canadians. I think they run a really unique business in this space. They're very tech friendly and very forward thinking in how they operate in this market. So it's a really great partnership with Parvis in that we have many of the same common values as far as what we're building and where we're heading. So it's awesome to have Alex here today to talk to us. On my end, I'll start with a quick disclaimer. So the content you hear today is not intended to provide and should not be relied upon for investment advice, tax, legal, or accounting advice. A little bit about Parvis, who we are and what we do. So Parvis is a technology-driven real estate investment platform and exempt market dealer. We're registered in all provinces in Canada. So what we're doing is bringing institutional quality real estate investment opportunities to eligible and accredited investors. And we're here to make that process as simple and as quick as possible. For more information, visit our website. That's it on my end. I'll stop sharing my screen here, Alex. I'll hand it over to you. Once again, awesome for you to take the time to talk to us, and I'm really looking forward to digging into more about Perch Capital.
Awesome. Thanks for having me. Appreciate your time and the opportunity to share a bit more about what we're doing with your investor network. So I am running Perch Capital. We're a mortgage investment corporation in Canada. So I'm based out of Toronto, but we work with lenders or with borrowers across Canada. So I also have a disclaimer that essentially
we all do.
This is not meant to be forward-looking advice or investment recommendations. So whether it's working with an exempt market dealer such as Parvis or with a wealth advisor that has the necessary accreditations, like Perch Capital is an investment that you'll have to purchase through an accredited channel. So let's start with the basics. So a lot of people are familiar with mortgages, but they are not familiar with mortgage investment corporations. So essentially, a mortgage investment corporation is when we collect capital from investors, we then pool that capital and originate mortgages to borrowers. Those borrowers make their mortgage payments, and we use those payments to pay dividends to investors. So ultimately, think of it as an alternative financing source for borrowers that come in certain unique situations where private capital is really the only option that they have. And as an investor, you can require higher than average returns, let's say, to a comparable investment because you're getting into those niche lending markets. But obviously, we have to be prudent about it to make sure there's preservation of capital in addition to good returns. So really, let's look at the broad landscape. So we're not the only MIC out there. There's hundreds of MICs across Canada. So some of them really have broad asset classes. So whether it's commercial, office, industrial, plus residential, there's a lot of diversification in some of these funds, but some of these are underperforming assets. A lot of investors are more interested in strictly the residential exposure, which isn't an option in some of these funds that have a heavy mix of other assets. Subpar returns and liquidity. So we've seen a lot of MICs out there are returning 7, maybe 8% to investors, which is arguably not that much more of a premium over a GIC, considering that you have a liquidity compared to a GIC, and then there's also that it's not guaranteed returns. We've also seen some funds run into liquidity issues in the last year or two, and they've had to gate or restrict redemptions completely. Sophistication is another area where a lot of lending that's done in the private space a lot of it is arbitrary, where you might just have an LTV minimum or a loan to value minimum, a dollar amount exposure, and there's not a lot of emphasis on credit score or the borrower's ability to repay. And lastly, there's problematic distribution. So since so many MICs are competing, or so many private lending options are competing for a similar pool of good business, there's a need to hire a lot of expensive sales resources, pay huge promos and things like that to incentivize business, which hurts marginal returns. So this is where Perch Capital comes in to really distinctively offer a better offering. So we have short-term financing solutions that help borrowers optimize their current and future transactions. With the key thing here I'll emphasize is we are huge on the exit strategy. So for us, there has to be a very tangible way to exit, and we're generating consistent returns for our investors while preserving capital within a risk tolerance. So let's talk about how Perch Capital is better, or what we offer in each of these categories. So we are 100% single family residential. We do not do commercial. We do not do land. We do not do any other type of property. We are strictly single family residential. That doesn't mean we aren't diversified. We do different property types. We're across Canada. So we get diversification through that rather than through other asset types. So we just stick to what we're really good at. And from a return standpoint, our returns are in the 9.4 to 10.3% range, which, as we discussed earlier, is about almost a 2 to 3% premium over what other funds are paying. And on top of that, we have much better liquidity due to the structure of our terms. So our average term is only 5 months and we don't go above 12. So our redemptions, we have a 60-day liquidity window that we typically can meet earlier if we have redemptions. We have very minimal redemptions. And on top of that, when mortgages mature, we can use those for redemptions as well. So from a sophistication standpoint, as Scott mentioned, we are very tech heavy in how we do things. So we have a core business as a brokerage, and we also have a lending arm, and we've built technology over the last 6 years that helps us auto adjudicate. So not only are we able to assess the risk profile very similarly to how a bank would look at it, we're actually also able to auto adjudicate and better assess the likelihood of an exit strategy. So when a deal comes in as a broker, we have a very good understanding of where are we going to put this deal after the private is done. So we're able to proactively go, okay, this is going to be in here for 5 months, then it's going to go to this lender after it's done. And we look at the entire holistic consumer profile. So we care about credit score, the ability to repay the property. We look at everything, not just an arbitrary risk metric. And selective distribution, what's important here is that our brokerage originates far more volume than our fund does. So we already have distribution just through our own means. And we have a lot of relationships with high producing brokers in the space that do private mortgages to accelerate and expand our distribution. Where that is also very relevant is it reduces our exposure to fraud since we control the deals. We're not controlled, but our distribution is more vetted, let's say. So it's like we have less likelihood of running into bad actors since it's essentially a controlled ecosystem that we lend on.
I'm just gonna go back to that slide if you don't mind.
Yeah,
You've
sure.
covered a lot of really, really important points quickly there, and I'd say, just to reiterate, I'd say the niche that you found around single family residential, what I've seen in the market is the mix that focus down on what they're really good at, perform really well. So that's awesome. I'd say the returns are fantastic for that type of asset class as well. So it speaks again to I guess the quality of your product, and of course the sophistication, and I think the way your business is structured with that distribution part of it is quite unique. So yeah, I just want to reiterate here, I think you've covered a lot of stuff here. So for anyone watching, again, go back a couple of minutes and listen again, because Alex has covered some really important points here.
Absolutely. And then the one thing I'll emphasize just when it comes to risk adjusted returns. So on top of paying a higher return, a lot of people might go, ooh, like it sounds risky, but like I'll get into these in later slides, but you'll see that we have a very good credit portfolio underneath it from the mortgages as well.
Brilliant.
So the one thing that's really important is to talk about why would you pick a MIC over other real estate investments. So especially in Canada, everybody loves real estate. Everybody knows somebody who's made money in real estate. But I think the part that's not as talked about is essentially what alternatives are out there. So let's start with effort involved. So a lot of people, so when I look at Perch Capital versus other options, rental properties would be essentially exactly what it sounds like. You buy a property, you rent it out, you act as landlord, and that's one way to get exposure to real estate. Another option is direct private lending or being an administrator or working through an administrator. So the difference here is that in Perch Capital, you're buying shares. It's a passive investment. You don't make investment decisions, and you're essentially trusting us to make the right real estate decisions. So you're buying into a fund. When you're a direct private lender, you actually have to assess your own individual deals that come your way, and you are the direct lender, which means you're also then responsible for everything that comes with being the direct lender. And lastly, there's the ability to publicly invest in MICs and REITs that are out there or other real estate real estate traded investments. So those are the 4 buckets. I'll start with effort. So I would designate that the publicly traded REITs and MICs and Perch Capital are the lowest effort, because other than the initial due diligence you'll make to go forward with the investment, afterwards, it's a very simple process. If you want to redeem, you redeem. If you want to collect investment, your dividends, your returns, they just come in. But you don't have to worry about default. You don't have to worry about any of these other things. It's managed by the fund that you're invested in. Rental properties, I'd argue, are the highest effort because it's a lot of due diligence for each individual property. But then if you're going to take on the responsibilities as a landlord yourself, which many people do, you're then having to deal with the tenants, the maintenance, the utilities, the property taxes. Like you have to manage all of that. And there's, there, while it's worked out great for some people, it has worked out terribly for others, especially if you have a very busy job. If you have a tenant who's not paying, it can take up to a year for you to get them out. And then you've got to manage the landlord tenant board, the court proceedings. There's a lot of things that you'd have to do.
Yeah, I'd say as far as a risk adjusted return goes, rental properties are not that attractive. I think because of one bad tenant ruins a year, if not more, of your return. I've got horror stories from the house that I actually bought. They had to pay the tenant $12,000 to move out.
Oh wow!
And that kind of and that was not uncommon, I think, from where I am in Toronto, and that sort of thing really hurts returns.
Yeah, and not only that, so actually, just because we also have the brokerage, like we see a lot of this because we have clients that own rental properties, and I've seen tenants just not pay rent, and it can take up to a year. And during that year, you still have to make your mortgage payments, so you have to take on private mortgages, unsecured debt, and it's pushed some people into default on their primary and on their rental property. So it is very much like a very higher. It's a much higher effort, but then that also ties into my second point of why it's also higher risk. And then as a direct private lender, it's a bit similar in the sense that you have to underwrite each deal you want to lend on. So your administrator will take care of the mortgage payments, a lot of these things from a servicing standpoint. But it's still worth remembering that if things go bad and there's a default, like there might be additional actions you have to take to enforce your position as lender, which could be very time consuming and also very capital intensive. For example, having to buy out the first mortgage lender if you're the second mortgage lender, things like that a lot of people might not consider. And then, so I think risk is more or less covered as we talked about kind of the differences between everything. So why I would have a medium risk profile versus low medium and let's say a REIT or a MIC for Perch Capital is more just because the risk of our fund would naturally be slightly less or a bit more risky than something publicly traded, because a publicly traded REIT is massive in size and typically has an established and long-term track record. Whereas, we have a 2.5-year track record. We're a bit smaller in size, or not a bit smaller. We are smaller in size. So we don't have billions of assets under management. So it's just something to take into consideration. But return volatility being the next key thing. And I think I have a slide for that just to show you. This is total return. So a lot of people look at yield, but you have to also look at the change in the capital gain of your asset price. So if you look at mix, and this is a basket of mix, not just Perch Capital, you see there's a very consistent trend across, like there's very few investments that will show you a straight line over the last 10 years. You see rental properties, I'm using the HPI index for Toronto, have bounced all over the place. And then REITs have also been pretty volatile. The main point here is the cumulative return, let's say with a rental property at 7.6 and a MIC at 7.8 is roughly the same. But one of the key things that investors look for is not just the return, but the stability of that return. And I'd argue here that, one of the main metrics for that is like a Sharpe ratio or something along those lines. There is no, like the MIC by far has a sizably better Sharpe ratio. And the main reason for that is as a privately traded asset, there is no asset price fluctuations. You buy at 100 and you sell at 100. So your share stability is there. So that's one thing to think about from a return volatility standpoint.
Yeah, it's an important point, and it's something that private markets fulfill that piece of a portfolio very nicely, and mix are an important part of that. In that consistent return over time as a piece of your portfolio, I think is something that sophisticated investors understand how important that is in portfolio structure. And as we see more and more investors come into our platform, and the more questions we have, it's part of it is educating them on portfolio structure and how important having that. I don't want to call it a base, but that consistent piece of your portfolio that's going to return year after year.
Yeah, and I think what really jump started a lot of people to soul search a bit more on that mentality is 2-3 years ago, the typical balanced portfolio of stocks and bonds kind of broke the expected behavior that both will never go down together. You have these so that you're protected of one against the other. But then bonds went down and stocks went down. So the only thing that didn't was alternative investment. So it was one of those things where now a lot more people are actively looking to make this part of their portfolio, having learned from that mistake. And a lot of wealth advisors are jumping on that as well to get educated and to start making this a priority. Looking at expected net returns, this is what we expect to return to investors in the next year. I've put 0 to 14% returns for rental properties, looking at total returns. So again, a lot of people are guilty of what I call real estate math. So I bought my property for this and I sold it for that. That's my return. No, you also had property taxes, maintenance fees, maintenance costs. Like there's a lot. So looking at the total returns of real estate, based on what we're seeing over the last few years, direct private lending has a bit of a wider range. And while you might be able to get a bit of a higher return by essentially cutting out the middleman, because now you're essentially your own lender, so you're not paying a fund to do it for you, there is the risk to net a bit less as well. Because the key thing to remember is when you're in a fund, you're fully deployed at all times. You're getting paid a dividend whether or not there's money that's going out the door. If you're a direct private lender and you only get one deal every 6 months, for the 6 months where you're not deployed, you're making zero, or whatever your high interest savings account is paying you. So that's just something else to consider. Investment in public REITs. So these are the high and lows over the last 40 years. So as you can see, a very wide range of returns from these investments as well. Liquidity is, so as I mentioned, we have a 60-day redemption window from a liquidity standpoint, so fairly liquid. Rental properties have very low liquidity, not because it's impossible to sell. Like you can list your property anytime you want to, but it's very expensive to do so. So you're typically losing about 6% of your asset value just in transaction costs to sell. If you list in a regular market, you might sell in 30 days if you're lucky. Then it takes maybe another 60 days to close. So you're looking at a minimum of 90 days. But if you're in some areas right now, properties are sitting for up to 6 months and they're not selling. So liquidity is going to be there at any price, something will sell, but then it's a matter of how much of a haircut are you willing to take. So with a rental property, it might take longer. As a direct private lender, there is very low liquidity because there's almost no secondary market for what that investment. So if you have a loan that you want to get out of, there's nobody you can sell it back to. You'd have to find somebody who's willing to assume your mortgage from you. And that almost never happens just because things might have changed. And also when you underwrote the deal, and we see this all the time. So let's say you underwrote a deal 7 months ago. At that time, you'll get job letters, pay stubs, bank statements. You do all the normal due diligence you would do or should do as a lender when you're lending to somebody else. But now let's say you did a 2-year mortgage, you're halfway through and you want to sell it to somebody else. Naturally, that person's going to want to do their own due diligence. The issue here is that your borrower has absolutely no reason or incentive to help you along with that process. Because why would they provide you with new documents if they already have a mortgage? So you're probably not going to be able to get updated information to give to the new lender, which means you're stuck until maturity is likely the only time you'll actually be able to offload it by a refinance. Investing in public REITs has very high liquidity because for the most part, you can buy and sell stocks through any trading account and you'd have funds the next day. So it doesn't get more liquid than that. Registered account eligibility. So Perch Capital is registered account eligible. So meaning RIFs, LIRAs, TFSAs, RSPs, you name it. Rental properties, almost always are not. You can put it in a holding company, but that's not a registered account. Direct private lending can be, but you have to essentially coordinate that yourself to make sure it's registered with the right trust company. And then investing in publicly traded REITs or MICs is also something that's registered account eligible. So that was a good summary of kind of how does a MIC fit into the general real estate landscape. So as you can see, pros, cons for all investments. So the returns are one thing, liquidity, risk, you name it, but it's not that one is necessarily the only one that you should ever do, but it's always worth considering maybe a mix. So I've met a lot of investors that are heavily like just rental properties, and I've seen them face negative cash flow. Whereas in a MIC, you're not going to be having negative cash flow because your dividends can only be positive. So it's something to consider of like what's important to you. Is it the returns? Is it the cash flow? Is it the work, the effort? So just something for you to really think about when you look at real estate investments.
For sure. And again, it comes back to where does this sit in your portfolio? What are you looking to get out of the investment versus the other things in your portfolio? You know, a lot of people have high growth tech stocks. That's great. They do really well in good times, but having something solid, low risk or relatively low risk and low effort. For me personally, I love that idea where you can just put the money and worry about other things in your life, not taking care of, uh, you know,
Fixing leaky faucets on your
fixing leaky
Saturday.
faucets, tenants
Yeah.
that don't pay, things like that.
And it can also, so it's a really good point. But the one thing also is like that preference can evolve over time. So you might have clients that bought 4 rental properties when they were in their 30s, 40s, and 50s. But now they're in their 60s, they're approaching retirement. Like, is it real? Like, is that really how you want to spend your retirement? And you might not have the capacity to like maintain these properties anymore. So a lot of people go, okay, well, I'm just going to get a property manager. It's like, all right, well, if they're taking, let's say, 8, 10% of your returns, is the net return still worth it at that point if you're giving up so much for the maintenance? So it's always good to be constantly reevaluating the asset based on your ability to essentially maintain it as things change. Because maybe as you approach retirement, you want to move to another province. Maybe you want to move to Florida. Then, like, I can't manage these properties from Florida. Um, so it's really all these things to consider of like you can still have real estate investments. It just might be a different structure that better fits your needs later on.
Fantastic.
So looking at the market opportunity, the private lending space is actually a $30 billion market in Canada, and that's just for the residential space. So we've estimated that essentially we think we can get about 60 million by the end of 2024 is our goal as we keep growing. And the market outlook is extremely positive for this space. So there's really 2 things driving demand for private lending. The first one is a tightening regulatory environment. So we've seen B20 back in 2018, 2020 with the it's a few revisions as well. But now we've got the elevated stress test, and then starting in January of 2025, we're expecting even more additional regulation from OSFI relating to income multiple restrictions on how much you can borrow from the bank based on your income. So a lot of these things continue to tighten what the banks or traditional lenders can do, which then pushes lenders into alternative lenders or private lenders. So that drives more demand for the borrowing on quality borrowers as well. So the second thing is then the housing affordability crisis. So private lending becomes almost a necessity for some of these situations because just housing is so hard to attain that there's a lot of situations where people get stuck in a position where they can't get financing and they're in a rush, and then private lending is typically the only option you have at that point. So the key thing is that private lending is always meant to be a temporary solution. You should never be in a private mortgage for over a year because at that point, there's no way you're making money because fundamentally, if someone's paying the lender 12, 13% for a mortgage, like no one's making a return on that. But why people would get it is because either A, there's a unique investment opportunity where it warrants it, or B, they have no other choice. So when you have a property that's closing and your financing fell through, you're going to lose your deposit. That's still more expensive than paying the 12, 13% for a few months. If you have, you also are going to be potentially getting sued for damages from the seller that you breached contract. So private credit or private financing is not meant to be a long-term solution. That's the key thing that I'll emphasize. So it's positive in that there's going to be more opportunities for private lending, but it doesn't mean that we want to essentially have the same borrowers for a very long time. It's really meant to be graduating. A bit of a portfolio overview. So this is as of the end of June. So our average mortgage is about 480,000. Mortgage position predominantly is first position. And just for those that aren't as familiar, a first position mortgage essentially means, so if I bought a house and I got a mortgage, that's a first position mortgage. A month later, or let's say 3 months later, I decide I want to do home renovations and then I can't get financing from my bank. I then go get a second mortgage. So the difference between a first and a second mortgage is a second mortgage, if the house goes into default and there's a liquidation, the first mortgage gets paid first, the second mortgage gets paid after there's anything left. So why that's important is typically just from that consideration, a second mortgage is riskier than a first mortgage, which is also why they typically charge higher rates. But the fact that we have almost 90% of them in first position is really a testament to the strong risk profile we have in our fund.
That's really impressive. That you've got 89% firsts.
And that's the one thing. And so on top of that, our loan to value, meaning on average for every $1 million of property value, I have $680,000 outstanding against it. These metrics are really indicative of a strong credit portfolio. So the one thing is when I talk about how we have a 2 to 3% premium, immediately a lot of people might assume, well, you're probably taking on way more risk to get there. It's like, well, no, we actually aren't. We're just getting better returns, and because we have lower operating costs and we have a better distribution. One other, I think I might have this in later slides, but just to speak to it now, the average credit score of our borrowers is 740. So we have very good borrowers, and we've been in inception for over 2 years that we've been lending now. We haven't had a single missed mortgage payment or default on our entire portfolio. So I don't think there's a single MIC out there that can say the same. So overall, like we have a very strong credit portfolio.
Sure, it's a impressive story over the last couple of years as well, with the stress out there in the market.
Yeah, exactly. So arguably the last 2 years have not been an easy market, but we've navigated it well.
Definitely. I
And then
mean,
just to speak,
just
oh yeah,
looking at that, just looking at how your portfolio is made up is, it's very impressive.
awesome. No, I appreciate that. And then there's two asset classes for Perch Capital. So direct investors. So for example, we use Parvis as our exempt market dealer. If you buy through Parvis, you'd be essentially getting a direct investor asset allocation. If you buy it through a managed account, so for example, if your wealth advisor is, let's say, with, I don't know, you bank with, or your wealth is managed by RBC or Fidelity or any of these other guys, they're doing a managed account, they buy it and earn a higher return. The reason why there's a higher return on managed accounts is you're typically paying your wealth advisor a management fee, which is anywhere from, let's say, it could be 1%, maybe it's 2%, depending on who it is. And we just pay a higher return to help compensate for that management fee. So that's the difference between the two investment classes there. And just to give an idea of the portfolio quality, this is relative to big banks. Like our uninsured originated loan to value, and actually, so sorry, the FICO score is actually closer to 760, not 740. You can see that there's not an overall massive difference between what we're originating from purely those few metrics versus what would be on the bank's balance sheet. And like I said, no missed payments, no mortgages in arrears, no defaults, and no expected losses on our entire book. One thing that's unique to Perch Capital is how we pay returns. So we have a preferred return structure where essentially it means that the investor or the borrower makes their mortgage payment. You are paid first. So the investor gets paid their return. We cover all the operating costs, and then we only essentially net a success fee if there's anything left over. So why this is different than the traditional fund is, one, we don't charge a set management fee. So essentially, if we don't make any money, like we don't think we're entitled to anything. Two, our fees and any other compensation that are brought into the fund are included in that total yield. So some people might be looking at 14 going, wow, that's pretty high. Well, because we are not taking any of the fees out of the fund. A lot of other MICs will essentially sweep commitment fees or lender fees into a subsidiary and remove them from the MIC, but we're essentially putting our profit in the pod to ensure that you get paid your distribution first. So the one thing to remember as an investor is that the preferred return structure is really beneficial for you because it essentially ensures that you get paid, and if there are any losses or any extra expenses, it would be coming out of our end before it comes out of yours. And one thing that's also unique is the structure within which Perch Capital MIC sits. So Perch is the parent company, which is a technology arm. So we're going strong for over 6 years. We own and operate a brokerage and a management entity. So we use Perch Mortgage Brokerage's distribution, since we have deals that are private lending, to really build a strong pipeline of candidates. And then we also have external brokers that we have relationships with to build our inflow into Perch Capital Management. But the technology that we built in Perch over the last 6 years is also helping us streamline a lot of the MIC. So back office automation, like we have no admin staff, like essentially distributions, accounting, everything's been automated to run seamlessly. So the lower our cost structure, the higher our ability is to pay higher returns to our investors. So there's a lot of that where we're able to run very lean. And in addition to myself, so I have 11 years in the space. Data modeling is really kind of my bread and butter back when I worked at the lenders. And it's not just me, though. I essentially have two advisors as well on the Perch Capital board. So I have Martin, who's been doing this for over 30 years and was previously VP at MCAN Equitable, so publicly traded banks. And then Michael Myers, who actually has been doing legal for over 30 years at his own law firm, and he enforces mortgages for some of Canada's major Schedule I banks. So really the right mix of operational efficiency, but also strong governance and oversight.
That's an important point. That was something sitting in the back of my mind when you showed me the no missed payments or no need to enforce so far. One of the questions I had was, how are you set up to deal with that inevitable scenario in this business? So to know that you have that type of person on the boards or on your team is that gives quite a bit of peace of mind.
Absolutely. Yeah. So it's really key in regards to, like, because the most important thing in any fund is your policies and procedures. So like, how are you going to underwrite? What's your process is? Then once you set that up, which is really where they're most instrumental, it's just executing within your parameters, right? So that's what we're able to do. So overall, essentially, we're raising capital. We've been growing slowly but surely. We want to be at 65 million by the end of 2025. And appreciate everyone's time, and I'm welcome and open to any questions you might have.
Awesome. Thanks, Alex. I think this has been really helpful. And also, I'd just like to say you've done a great job in presenting the information as well. I think the simplicity in which you've presented it, some quite complex financial data there and around your fund is, yeah, hopefully that gives our investors a really nice insight into what you're doing.
Awesome. Well, I appreciate that. It's yeah, it's a simple product, and I just got to keep it that way.
It is. All right. So thanks, Alex, everyone. Thanks, everyone at home. Please reach out to the team at Parvis to make an investment into this product. We'd love to have you, and we'd love to, yeah, get you involved with Alex and the team at Perch Capital.
Awesome. Well, bye, everybody.
Great.
Appreciate your time.